Uh, Welcome to another episode of Phillip Trading Podcast. My name is William, and our speaker today is Trent, which is the marketing and dealing executive of Phillip Futures. So today we will be discussing on what does the latest FOMC meeting means to the global market and what kind of effect we could see on different asset class as a result of the decision by the FOMC. So for those that are watching this podcast, feel free to share this section on your Facebook with your friends, okay? It's always good to share with your friends. And you can also comment in the comment box below to ask us any question or any topics that you want to hear from us. So Trent, how have you been, Trent?
Yeah, I'm feeling good.
Doing good? Okay, so let's start our Q&A section. So the first question here is that can you just briefly let us know what is FOMC and why is it important for our fellow traders and or investors to take note in case they are not familiar with FOMC?
Okay, yeah, sure. So basically the Federal Open Market Committee, known as the FOMC, is the branch of the Federal Reserve that determines the direction of monetary policy in US. So basically the FOMC will meet 8 times a year to discuss whether there should be any changes to a near-term monetary policy. So they will meet for 2 days, and the FOMC will discuss developments in the local and global financial markets, as well as economic and financial forecasts. One thing to note is that the meetings are not held in public and therefore are subject of much speculation on Wall Street, as analysts attempt to predict whether the Federal Reserve, in short, will tighten or loosen the money supply with a resulting rise or fall in interest rates. As US is still the largest economy in the world, their monetary policy will definitely have an effect and influence on the financial market in other countries to a certain extent. This is why FOMC is quite important to our fellow traders and investors.
Okay, so now everyone has a rough idea on what FOMC is. Let's move on to the next question. So on 17 March 2021, the Fed has decided to keep its interest rate near the zero level until 2023. So what effect can we see on the equities market with this decision?
Okay, so in my opinion, right, it's actually a good news to the US equities market when the Federal Reserve decided to keep its interest rate near zero until 2023. With no immediate plans on tapering from the Fed, the US equity market will likely to continue its uptrend, mainly fueled by the USD 1.9 trillion spending stimulus introduced by the US government, and also the smooth rollout of vaccines. In fact, right, the S&P 500 and also the Dow Jones Index closed at record high on Wednesday after the Fed predicted a fast economic recovery from the coronavirus pandemic and said it would maintain interest rate at close to zero. And also it was the first time that the Dow closed above 33,000 points.
Okay, so you reckon that the equities market is most likely to continue the bull run for the rest of 2021. Now, other than equities market, what about the impact on the bond market, especially on the US 10 years bond yield? I believe this is one of the spotlight for most of the investors and also one of the concern for most of the investors right now.
Yep, as for the bond market, I guess again a little bit tricky. So I reckon the recent rally in the 10 years US Treasury yield will likely to cool down for the short term at least. Currently, the 10-year US Treasury yield had dropped from its 13-month high at 1.74% back to 1.64% currently. Okay, in my opinion, right, if there's no extremity in the upcoming inflation or growth data on the US economy, I expect the long-term US bond yield to remain at current levels. While inflation is expected to reach 2.4% this year, which is above the central bank target of 2%, the Federal Reserve Chairman Jerome Powell called it a temporary surge, so no risk that will not change the Fed's pledge to keep its benchmark overnight interest near zero. And also the Federal Reserve projected the US economy will grow by 6.5% this year, which is one of the largest annual outputs since 1984, thanks to mainly due to the massive federal fiscal stimulus and also optimism around the success of coronavirus vaccines. As long as there's no upcoming data that is, as long as the upcoming data is still within the range. I foresee no major movement in the bond yield.
Okay, so in short, as long as the inflation kept below the 2.4%, we shouldn't see any major movement on the bond yield in the short period. Okay, now the gold price has dropped by more than 10% since the start of 2021. Okay, do you think the low interest rate environment will lend a support to the gold price, given that the economy is en route to recovering with the rollout of vaccine? Do you think gold price can still support with this low interest rate environment?
Okay, so in my opinion, I think the downtrend in gold will likely to continue in 2021, despite the low interest rate environment. If you observe the behavior of gold last year in 2020, its rapid rise is mainly driven by the fear of a major recession in the global economy due to the COVID-19 pandemic. However, with the massive government stimulus and also smooth rollout of vaccine in US, the US economy actually experienced a V-shaped recovery as shown by its inflation and growth data. So as such, I think if there's no another shocking event, then I expect the gold price to return to its pre-COVID level at around 1600 level.
Okay, so for those that are interested to trade gold, Phillip Futures, we do offer micro gold contracts with very affordable margin. Okay, so traders, if you think that the gold price is going to return to drop to the pre-COVID level, you can short the gold market. Okay, you can short it with the micro gold contracts. Last question, Trent. Although the Fed said that they won't increase the interest rate until 2023, do you think that Fed can still change their mind to increase the rates before 2023? Why?
Yes, of course, definitely they still can change their mind. So in my opinion, I think the Fed will change their mind if the US economy is overheating. So what does it mean by overheating? So the inflation target by the Fed is actually 2%, as everyone is well aware of. And if the US economy experiences inflation at around 3% consistently for at least 1 or 2 quarters, okay, then I reckon there might be intervention by the Federal Reserve to slow the inflation down. Then another possible scenario is that there is the financial asset bubble due to the massive stimulus injection by the government. Although currently the Fed still perceive the equities market valuation to be healthy, the situation might get ugly if the financial market goes up too fast, like the dot-com bubble or the subprime mortgage crisis. Nonetheless, learning from experience, I reckon the Fed will watch the financial market closely before making a move to intervene.
Okay, so once again, if you are interested to find out how you can participate to trade gold or US equities, feel free to drop us a message on our Facebook page, and our representative will contact you as soon as possible. And again, thank you, Trent, for sharing today, and see you next week.
Okay, bye-bye.
Bye-bye. Thank you.